Hey all, welcome to this episode of A Good Problem to Have. I'm your host, Tyler Olson, and today is going to be the start of a mini-series of episodes designed to help those of you who are graduating medical school and transitioning to intern year. Now, there's a lot on your minds right now. We are 7 days away from the start of match week as of when I'm actually recording this. There's a lot on your minds, I'm sure, in terms of your career. I want to be able to help you through the course of 8 topics to be able to identify what financial decisions you need to make and how to best go about them. Bear in mind, too, that I'm going to be talking about this fairly extensively during our post-match financial education webinar, which is on Friday, April 10th from 1:30 to 3:30 p.m. Eastern Time. I'll also be posting this on that webinar itself on YouTube after the fact for those of you that aren't able to make it. In any event, I'll start us off with our first topic for today, and that is managing federal student loans. You'll notice that I'm making a demarcation from private loans because they're definitely a different beast that needs to be handled differently. And the federal loans, they just have a lot more potential benefits, more rules, and related decisions. So we're going to just talk about the federal student loans today. If you've not done so already, it's imperative that those of you who are about to get into intern year and out of medical school, you need to file electronically a tax return for 2025. This is really important so that you can keep your student loan payment as low as possible when you actually have to start making payments. Now, the viability of doing this, of course, is dependent on, one, you are in fact not out of school already. Some of you graduated in December. Some of you are applying for the match again, and you've been out of school, and perhaps you're doing a research year or some other work while you wait to apply for the match again. So this may not apply to you and apply to every single one of you. But the reason why it applies to most doctors who are applying for the match is because last calendar year, you made very little, if any, income, right? And when you actually have to start making student loan payments, which could vary, I'll get to that shortly, but it could be anywhere from July starting until or as late as November, December of this year when you'd have to start making payments. If you made no income last year, that is a resource that you can utilize to be able to garner a $0 payment on your federal student loan payment. The reason why that's the case is because the income-based repayment plans, or the income-driven repayment plans, I should say, their calculation is predicated on previously verified income. Now, sometimes if your income is lower, you can actually just, you don't want to use last year's tax return, you want to use like a pay stub. But we're probably not talking about you all because you made no money in 2025. And so if you electronically file a tax return, that's a very easy way to prove, hey, I didn't make any money last year. And so the calculation is 0 or very low. Obviously, with these the new plan that's come out, the RAP plan, it's not going to be nothing if you're on the RAP plan, but it will be quite minimal, the amount that you'd have to pay per month. Whereas if you apply for IBR or pay, those are certainly going to be based on a percentage of your disposable income. And if your disposable income was 0, they could charge you 100% of your disposable income. 100% times 0 is 0, right? So you want to use that as a resource, but you must electronically file the return. I keep saying that because so many times I run into med students, interns who they are like, oh, I sent in a paper copy because when I tried to do it on TurboTax, it said you don't have any income, so you can't e-file a tax return. And I thought, oh, I'll just send one in the mail. And if that's the case, that's not going to make it into the system. And when you apply for IBR, pay, or wrap, that information is not going to be in the system. And they may pull from 2024's tax return if you happen to e-file that one, although that seems unlikely for many students. The next course of action would be for them to ask for your pay stub. And if you apply this summer to get onto an income-driven repayment plan, you're going to be making, it's not like you're not making attending money yet, but, if you're making $60,000, $70,000, $80,000 a year, that's going to be at least a few $100s per month. Whereas if you had e-filed a tax return based on last year, $0, you would have had a $0 payment. And the transition from making nothing to making some income is challenging, and it's nice to be able to soften that blow. So that's why I recommend it. Now, some will say, well, what do I do if the software tells me I can't e-file a tax return? First of all, don't use TurboTax. Use Free Tax USA. Free Tax USA, in my experience, has had a much higher success rate of not kicking back on $0 income people and saying, oh, you can't e-file. It lets you e-file anyway. But even if that is the case and it says, well, you don't have any income, why are you filing a return? You can go into the other income section, interest income, and just put $1 into other income and make it someone, if it requires a person's name, like where you earn the income or whatever, then, make it a person that you could have theoretically borrowed money from and they charged you interest. There is no tangible benefit that you're getting from this in terms of a tax refund. You're not going to be getting money from the government that is not owed to you because of writing this $1 in interest income. So it's certainly not illegal to do so. But this way, with the system, it's like, oh, I did have income. I had $1 in interest income. Then that has often proved to work. The other thing that you want to keep in mind is that, if the software kicks back, try a different one. Another one that I've had success with was TaxSlayer. And I have had TurboTax work too, but TurboTax is annoying for other reasons. So that's why I tell you, first try Free Tax USA. And because your income was so little, you'll also qualify for not having to pay for the e-filing process. Some people ask me if you have to file a state tax return. A state tax return. If you didn't make any money, you don't have to file a state tax return, and the Department of Education does not pull from your state income tax return, just your federal tax return. So if you made no money, you only need to e-file a federal tax return. So that's like on the docket for like right now. April 15th is the deadline for e-filing a tax return. So you want to get on that. The second consideration in this realm is tax filing status. This is for people who are married. If you're single, you don't necessarily need to pay attention to this part, although if you do plan on getting married in the future, this will be relevant to you if you still have student loans, and particularly if you're trying to go for public service loan forgiveness. Filing jointly versus separately is a bit of a quagmire. The tax liability difference exists. In some cases, the difference is minimal. In other cases, it's substantial. In some cases, the calculation for one versus the other does not take a tremendous amount of work. However, if you are in one of the community property states, then it does get a little bit more complicated. So for example, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin. They use a community property system. And when you file your taxes separately, it doesn't just separate your income from your spouse's. It takes the whole amount of income between the two of you and cuts it in half. So that might mean, like, if you made no money last year, but your spouse made $70,000 and you live in Wisconsin, now filing separately, that would mean you have $35,000 in income and they have $35,000 in income. It still might be better to do that, from a student loan payment perspective, because the percentage that you owe based on $35,000 in income would obviously be less than $70,000. But what's the tax liability difference? If you live in one of these states, I know you all don't have very much money, but I really do think it would be worth paying someone. Obviously this is pretty late in the game, and I know my guy Adam Markowitz at Luminary Tax Advisors, he and his team do great work. I don't know if he can, if he by the time you contact him, if he has room or not, but he has consistently done excellent work in being able to help new doctors figure out this question of whether it's worth it to file jointly or separately. He's a student loan expert too, so he can help with tax filing and the student loan piece, by the way. In any event, this is a decision that needs to be managed carefully. If you want to DIY this, you can try to run this through I keep saying it wrong, Free Tax USA, where you're filing jointly, and then start over and do it separately and see what the tax liability difference is. You got to be careful with this online software, though, because a lot of them make major mistakes with community property state situations. So if you're going to DIY, you might have to accept the possibility that you're going to have to amend your tax returns retroactively with a competent accountant, and that of course costs more money. So that's why I think if you're married and you're in one of these states, you should heavily consider hiring a tax professional. The challenge also with this decision, it's not just about the student loan payment. It's also about cash flow. Sometimes if you're going to get like a really great refund if you file jointly, but then that's going to result in a higher student loan payment later, that can be tough, especially during this transition from medical school to intern year, because a lot of people, they got stuff to pay for, and you're not going to get any money, no income until probably the first week of July at the earliest, sometimes as late as the first week of August. So maybe the refund is something that you really need. It deserves discussion. And so that's why I'm talking about this first, because April 15th is just around the corner, and that's when these decisions need to be finalized. Third point. So e-file taxes, compare filing jointly versus separately for those of you who are married. And then the third is consider whether you're going to file a consolidation application after graduation. This has to do with when you're going to have to start making payments and when your payments could begin counting toward public service loan forgiveness. If you do not do a consolidation application, it will automatically put you into a 6-month grace period from the date of your graduation. So if your graduation is May 15th, then you would start making payments after November 15th. And that can be helpful because you have nothing to pay at all. But then your PSLF qualifying payments, they also do not start until December in this case, or November if your payment date is in November. The reason why you might want to go ahead and do the consolidation, though, is especially if you had no income last year. Because if you can e-file a tax return, as I recommended with step 1, then you're in a situation where you can have $0 payments anyway. So, if you have to start making payments in July, but the amount that you owe is $0, and they count toward public service loan forgiveness, which they do, if you're on an IDR, even if the required payment is $0, those count toward the 120 payments, then why not do it, right? You would theoretically grab up 4 or 5 more months worth of payments. And trust me, on the back end of this, in the year 10 timeframe, you are earning much more income, and all of a sudden these monthly payments of $3,200, and you're thinking, oh man, I could have had like these 4 payments done. I'd have $12,000 more. And it's not the end of the world if you can't do this. But if you are planning now and you act shrewdly here, it's a way that you could that much further increase your chances for increasing your public service loan forgiveness amount. Even if you're not going for PSLF, this is another question. People are like, well, I'm not going for PSLF. I'm going to go into private practice. I want to start my own cardiology practice. I'm not working for a nonprofit after training. Even then, managing your cash flow while you're in training is a real challenge. And being able to keep your payments minimal is a good idea. Being able to pay off these loans quickly it does not need to be a priority. If you happen to have a household income like where your spouse is making a bunch of money, then maybe you've got a different situation. But for the lion's share of residents, this is not something that needs to be dealt with. Prioritize protecting your time, your mental space, your health, so that you can focus on your training, your health, and your relationships. Helping to keep your student loan payment to a minimum during these very heavy years is a great idea, in my opinion. Within the consolidation application is your selection of which income-driven payment plan you're going to pick. So if you opt to do this right after graduation, after your school has updated your name in the National Registry saying that you are actually graduated, you can apply for a consolidation application through studentaid.gov. And then within that application, you have to choose, am I going to pick pay? Am I going to pick IBR? Am I going to pick the WRAP plan? If you have no loans ever from prior to July 1st, 2014, IBR is a great option. If you have a lot of family members, like if you've got a bunch of kids, then there are some scenarios where the WRAP plan is a better deal as, while you're in training. But as your income grows and grows and grows, eventually IBR starts to perform better again. So generally speaking, I like IBR. Now, if you have loans from prior to 2014, and I don't mean that you consolidated everything after 2014 and so everything looks like it's new. I mean, if you borrowed money from the federal government prior to July 1st, 2014, then IBR is going to be more expensive for you. You're going to be paying 15% of your discretionary income instead of 10. And whereas the pay plan, which still exists right now, that is at 10%, even if your loans are older. So you may want to pick the pay plan. Pay, I mean PAYE. All right. So you got to make that decision. That's also very nuanced. And, you got to do it based upon your, family size, income level, and, but all these plans, they qualify for PSLF. So if you do the consolidation in June, presumably, and then choose one of these plans, then you'll get your application approved. You'll start making $0 payments if you e-filed your tax return from 2025 and you had no income. And then you have PSLF payments counting right away, which is great. The last thing you got to do, make sure that you certify your employment annually. This is something I usually recommend doing around the beginning of the academic year, just because it's like you're already kind of in the cadence of things switching up around that time every year anyway, right? So this is where you update how many payments have qualified for PSLF. So this is important to do. Technically, you don't have to do it every year, but I like to do it because it helps to keep the payments that are counted to be, helps it to keep that number fresh. And your, what was I going to say? Like your employer or like HR person, they know you. You don't want to be like a couple of years out of training and have to see if you can try to track down your, program director or assistant or someone that can corroborate your income from 7 years ago. So it's good to try to have a good routine of maintenance here. This helps to keep updating the numbers. And then this is another thing. It's not really anything to do, but you'll be required to update your income to recertify your income periodically. And that's just going to be notifications from your loan servicer. Future tax filing decisions and timing will come into play. So you may want to file a tax return extension for the 2026 tax year if your recertification, your income recertification is in, say it's in July of 2027. If you were to file an extension on your 2026 tax return, that means that you don't have to technically e-file until October 15th of 2027. And so when you update your income in July of 2027, it's not going to pull your $30,000 that you made in 2026. Instead, it's still going to rely on your $0 2025 tax return, which is great, which means you can get another year of $0 payments, right? So there's a lot of strategy that can go into this depending upon your interest level and how much it moves the needle for you personally in your life. Anyway, this is step 1 of 8. Catch you next week. Thanks for listening.